Okay, let's unpack this. Welcome to the deep dive. Today, we're tackling a really fascinating investment strategy, one that promises something incredibly appealing: monthly income. And we're talking high income, often showing yields, annualized way up over 20%. We are diving deep into the RXNG and Innovation Equity Premium Income ETF. That's FEPI, FEPI. Now, look, for anyone focused on cash flow, and let's face it, that's a lot of investors these days, yield like 20% plus. It's magnetic, but we know better than to just chase the headline number, right? Our mission here is to cut through that noise. Is it fund a high yield machine, or is it maybe more of a long-term capital track? We really need to understand the trade-offs, the mechanics behind it.
Right. And to just set the stage simply for you listening, FAPR, it's an actively managed ETF. Its whole goal, its entire purpose, is generating income. And it does this using a specific options strategy called the covered call. What makes FPI stand out, though, is it applies the strategy to a really concentrated group of stocks, just tech and innovation names. And our sources, they lay out exactly how it works, the rules, and importantly, the significant risks that come with those rules.
Okay, so let's start right there at the foundation, the equity part. What this income engine actually built on. The name says FNG and innovation, but how many stocks are we really talking about here?
Yeah, the number is critical. FPI holds only 15 stocks. 15! These are the big tech and innovation companies. The Magnificent Seven types are in there, sure, but also giants like Microsoft, Google, Intel, AMD, and right away, that should set off, maybe not alarm bells, but a signal. Because 15 stocks, that is not diversification.
And when you look at broad index funds like the S&P 500, the weighting is key, isn't it? Sometimes the top few companies just dominate everything. Does FEI work like that?
That's actually one place FPI is different, but like you said, not necessarily safer. They use an equal weight policy. So unlike those big indexes where Apple or Microsoft might be, 7, 10% or more, FPI resets things. At rebalancing, every single one of those 15 stocks gets roughly the same weight, about 6.66% each. It's a deliberate choice. They're trying to stop one huge company from just, overwhelming the fund's performance. But, and this is crucial, that equal weighting, it doesn't fix the concentration problem, not at all. The fund itself is explicitly labeled non-diversified. That's the official regulatory term because it holds so few tickers. And what that means, practically, is volatility. It's going to be super high. Think about it. If you own an S&P 500 ETF and one stock tanks, you barely feel it, right? But with FEI, if just one or two of its 15 holdings get hit hard, say, some bad news specific to them, the whole fund is going to feel that impact much, much more severely. Faster, too.
Right. The smaller the boat, the bigger the waves feel. Makes perfect sense. Okay, so we have this concentrated high volatility basket of stocks. That's the raw material.
Right.
Now, here's where it gets, really interesting. How does this tiny portfolio generate a yield that just blows almost everything else away? It's this option strategy, right? The covered call. Can you walk us through how that generates the income?
Yeah, the covered call idea itself is structurally pretty simple. The fund owns the stock already. That's the covered part. Then it sells a contract, specifically a call option to someone else. By signing that option, the fund is basically selling the right for the buyer to purchase that stock away from them, but only at a specific price, the strike price, and within a set time frame, usually about a month for these kinds of funds.
So it's almost like the fund is acting as an insurance seller. Or maybe renting out the potential growth of its stocks. It gets paid a fee for giving up that upside.
That's a really good analogy. Let's use the example from our sources. Say the fund holds shares of Tech Corp, trading at $100. The fund then sells a call option. This gives someone the right to buy Tech Corp from the fund at, let's say, $105 anytime in the next month. Now, because the fund is giving away that potential upside, the chance for the stock to go above $105 gets paid cash right away. That payment is called the premium. Let's say it's $2 per share, that $2 deposited immediately into the fund's account. And that huge monthly distribution that investors get, that big yield figure, it's mostly made up of this premium. The cash collected from selling these call options on all 15 stocks month after month.
Okay, that's clear. But is the strike price, the $105 in your example, always set above the current price? Because if they sold the call right at $100, wouldn't any tiny upward move mean the stock gets called away immediately? Seems like you lose all the growth potential instantly.
Good question. No, FEI generally sells what are called out of the money, or OTM, calls. That means the strike price is set above the current market price, just like the $105 strike when the stock is at $100. And this is absolutely key. It means the fund still has some room, some buffer for the stock's price to go up. In our example, it could rise by $5 before that option gets triggered, and the stock has to be sold. They're trying to collect a good premium, obviously, but without immediately capping all their gains.
Got it. So the engine is 15 concentrated stocks, constantly selling off their near-term upside potential in exchange for big slugs of immediate cash flow. Now, we absolutely have to get into the potential trap here, this high distribution yield. But before we dig into the yield numbers themselves, let's quickly touch on the competition again. You mentioned other covered call ETFs.
Right. If you look at some other big popular covered call funds, maybe like JEPQ or QQQI, they often base their strategy on the NASDAQ 100 index. That means they're typically holding around 100 stocks, Fepi holding just 15. That's not just a minor difference. It reflects a fundamentally different approach to risk. Like we said, if one company out of 100 has major issues, the impact on a fund like JEPQ is buffered. But if one of FPI's 15 holdings implodes, an accounting scandal, a product failure, the damage to the fund could be quite severe.
Yeah, that concentration risk seems like it looms over everything, and it makes this next part even more critical. We need to talk about the numbers investors see. There's the big attractive number, the distribution yield, and then there's this other number, the one regulators make them calculate, the 30-day SEC yield. Can you break down the difference for us? Because this seems crucial.
It is. Honestly, if you take away only one thing from this deep dive, this should probably be it. First, you've got the distribution yield. That's the headline grabber. Sometimes 25%, maybe even higher. It's calculated simply by taking the most recent payout, annualizing it, and dividing by the share price. It's just telling you what the fund paid out. But then there's the 30-day SEC yield. This is a standardized regulatory calculation. It's designed to measure the fund's actual income. Think dividends, interest earned, minus the fund's expenses and management fees. It's supposed to reflect the true underlying profitability.
Okay, so what does that 30-day SEC yield usually look like for funds like FEPI, these high distribution covered call funds?
This is the kicker. It's very often negative.
Negative.
Yes, negative. And that's the big red flag. If the official measure of true earnings is negative, it tells you something vital about that huge distribution yield, that 25% figure. It means that payout isn't just profit generated by the investments. It's largely being funded by the option premiums, yes, but also by something called return of capital, ROC.
Okay, ROC, return of capital. We need to spend a moment on this. What exactly does that mean for me, the investor, and my long-term money?
Return of capital means the fund is literally giving you back a piece of your own investment principal. Or it might be selling off some of its existing shares potentially at a loss, it doesn't matter, just to get the cash needed to make that promised high distribution payment. Think of it like this. You invest $100. That's your principal. The fund promises to pay you, say, $25 over the year. That's the 25% distribution yield. But if the fund, according to SEC yield calculation, only actually earned maybe $5 in real profit, well, it still needs to pay you the $25 it promised. Where does the extra $20 come from? It comes directly out of your original $100 principal. They just hand it back to you.
Wow. So while I'm getting this amazing cash flow every month, feeling good about that, the actual value of my investment, the net asset value or the NAV that's going down, it feels like, you're guaranteed to shrink your capital base over time. Is that fair?
That is the fundamental trade-off. You are explicitly choosing immediate high cash flow over capital preservation. This RSC mechanism, by definition, erodes the fund's net asset value over the long term. Every time the fund pays out more than it truly earns, the overall size of the fund shrinks. So yeah, you might feel rich today getting those big checks, but the underlying pot of money you invested is getting smaller tomorrow. If your goal is saving for retirement or just generally growing your capital, this structure actively works against that objective.
That really puts the appeal in stark contrast to the reality. It's like a psychological win. The big payout feels good, but potentially a financial loss if the NAV keeps dropping.
Yeah.
Okay, let's put this strategy through its paces. Using the sources, let's run a sort of stress test. What happens to an investor in FPI in different market conditions? Let's take the three main scenarios.
All right. Scenario 1, the bull market, the one everyone hopes for. Let's say those 15 tech stocks do what tech stocks sometimes do, and they rally hard. Maybe they jump 20% in a year. What happens to FPI? It suffers from what's called capped upside.
Right, because of those call options it sold. Walk me through the math on that. How much gets left on the table?
Absolutely. Remember, the fund sold those out-of-the-money calls. Maybe it set the strike price to capture only the first 5% of any stock growth. So the stock goes up 20%. The fund only gets that first 5% gain before the stock is called away. It also collected that option premium. Let's say it was 2%. So the fund's total return is 5% from the stock gain plus 2% from the premium. That's 7% total. But the underlying stocks, they went up 20%. The FBI investor missed out on 13 percentage points of potential gains, 20% minus 7%. Plus, you still have that potential NAV erosion from ROC happening in the background, even in a rising market, if distributions exceed true income. So the fund massively underperforms just, holding those same 15 stocks directly.
It's almost like you get punished if the stocks do really well, which is completely counterintuitive to how most people think about investing.
Exactly. You get left behind in a strong rally. Now, scenario 2, sideways market. What happens if those 15 tech stocks just kind of chop around? They trade in a narrow range, maybe moving up or down just a couple of percent over the month, essentially flat overall.
Given everything we've said, this sounds like it might be where FPI is supposed to shine.
This is the best case scenario. This is exactly what the fund is built for. Those call options it sold, the ones with the strike price maybe 5% above the market, they expire worthless because the stock never got high enough to trigger them. So the fund just pockets the premium. It collected that 2% or whatever it was essentially for free. It keeps its entire stock portfolio intact, and it generates that consistent high cash flow without having its stocks called away, without needing to dip heavily into return of capital. This is the sweet spot, extracting income from market chop or low volatility in a generally flat environment.
Okay, makes sense. But then there's the flip side. Scenario 3, the bear market. What happens if those 15 concentrated stocks drop hard, say down 20% in a rough period?
Yeah, this is where the strategy offers only limited protection. That premium the fund collected from selling the calls, let's stick with our 2% or maybe 3% example. It acts as a small cushion, just a little bit. But if the stocks themselves fall 20%, that 2-3% premium only offsets a small fraction of the loss. Your net result is still a significant loss, maybe negative 17% or negative 18% in this example, the negative 20% stock loss minus the 2-3% premium gain. And this is where that non-diversification really bites again. Because it's only 15 stocks, a sharp downturn in tech could hit a Fepi much harder than a broader market index fund. That premium income is just a drop in the bucket compared to a major equity sell-off.
Wow. Okay, this has been a really crucial breakdown. We've seen FAPI is it's a very specific tool, a hyper-focused financial instrument really designed for one thing, generating high immediate income, especially when markets are just moving sideways. But, and we really can't stress this enough, right? That cash flow comes with some very steep, very defined costs. You've got the capped upside in bull markets, the extreme volatility because there are only 15 stocks, and this constant background risk of long-term capital erosion through return of capital.
Absolutely. And that really brings us to the final thought, the question you, the listener, need to consider. Given this extreme concentration, just 15 stocks, and the fact that the 30-day SEC yield is often negative, if your main goal, your primary investment objective is capital preservation, meaning you want your $100 today to be worth more than $100 in 5 or 10 years, then you have to ask, is that promise of immediate high cash flow worth the very real inherent risk that the underlying value of your investment, the NAV, will actually shrink over time? That is the fundamental trade-off. It's the core decision every potential investor in this kind of fund absolutely must weigh before jumping in.